we begin with the stock to watch tonight. That would be Disney. Shares are jumping after the media giant reported better than expected earnings. CNBC's Julia Borson just sat down with the CEO, Bob Iger, joins us now with the very latest. Julia.
Melissa, that's right. While Disney beat revenue and earnings expectations driven by success at the parks and the studio, the big news is about Disney's big bet on streaming, with Disney Plus launching Tuesday. Bob Iger announcing in our interview that Disney Plus has a distribution agreement now with Amazon, Samsung, and LG. That's in addition to other existing agreements with Apple, Google, and others. Iger also announcing a new plan to bolster Hulu with FX.
For the first time, FX will be creating original series for Hulu. In fact, we're going to start with 4 of them. There are 4 of them in production now, and they'll be available on Hulu starting in probably late March. We're also going to enable viewers to watch FX shows on Hulu soon after they have aired on FX, just a few hours later.
Iger announcing that ESPN Plus now has 3.5 million subscribers. That's the addition of over 1 million over the course of the last quarter. Now, I asked Iger if all of Disney's investment in streaming threatens to cannibalize its core media networks business.
We don't believe that what we're doing is really damaging our bread and butter, to use your words. What we really are doing is really a couple of things. First of all, we're giving consumers an opportunity to watch sports in new, sometimes considered more modern ways, more convenient ways. We're also establishing a path for us to continued, basically, success or profitability should the initial or the traditional business model be disrupted to such an extreme that it's a necessary transition that we have to make.
Now, Disney's earnings call is going on right now, and the company's CFO just announced that protests in Hong Kong have led to a significant decrease in tourism, and they do expect operating income at Hong Kong Disneyland to decline about $80 million in the fiscal first quarter. That's this current quarter. Now, Iger said he's not focused on competition. We asked him if he subscribes to Netflix. He admits he does. Melissa, back over to you.
All right, Julia, thank you. Julia Borson in Los Angeles for us. Let's go to the man who owns Disney and also successfully fast-pitched Disney. So you're riding high tonight.
The blind squirrel, as we say. Yeah. But the thing about Disney that got me so excited on that fast pitch was that this is a company that I want to own for 4 different reasons. Studio, parks and recreation, DTC, or consumer products, and ultimately the streaming service and the media business. And this is something around the media business, we don't really know what blended multiple to apply to the company. But when you look at parks and studio, I mentioned that studio is the gift that keeps on giving. So studio drives parks, and it drives all the consumer products business. Whether that's driving ultimately the streaming business, we'll see. Disney certainly has made between that Amazon distribution deal and the fact that they've got every major distributor out there. And I would argue, who do you want to have? I would much rather have Disney than almost anybody else if I'm a major. If they had to choose one, I think they'd rather own Disney. So you look at the multiple, you look at where this stock relative to the rest of the market. You know, you could have bought Disney today before this numbers if you were scouring and screening to see what hasn't run, what's a blue chip, what's a valuation. And I think you still can do that after these numbers. So these were great numbers. We didn't even learn anything about the streaming business, and yet we know that they're going to be in the thick of things.
Right. What you mentioned was the flywheel effect. I mean, it's got that going right now, and theoretically, it should help the streaming business as well. I mean, if it helps studios, it should help that content, right, which will then be on the streaming service.
Right, right. He does sort of just touch on the idea of the cannibalization of it. He denies that that's an issue, but it has to be an issue, right? I mean, ABC, linear TV, that has to be an issue, but good for them. You can either do something about it, which they absolutely are, right? They're absolutely addressing it. I kind of agree with Tim. I mean, the numbers were great, but it's up nicely, but it's not materially more expensive today with these earnings even up this much. The story's still very much.
I think the streaming stuff's really interesting. I listened to the whole interview that was on in the 4 o'clock hour. I mean, what was, he said they gained 1 million ESPN Plus subscribers. They have 28.5 million Hulu subscribers. I think Hulu is a really important part of this direct-to-consumer bundle. This is also live TV, and it's one way for them to aggregate a lot of their content in a different sort of way. And I think that investors are willing to give Disney a pass, especially with those losses right now as they ramp this service. I don't think, and expectations for Disney Plus are maybe 5 million by the end of the year. We know they just launched that deal with Verizon. Verizon has 150 million subs here, so that could be a very sticky thing. So I think you're probably going to see expectations for Disney Plus Plus kind of ramp for 2020. And going back to your blended multiple, if you looked at in the quarter, the media revenue is about $6.5 billion, and direct-to-consumer is about half that. So as long as they, back to your cannibalization issue, they keep growing that at a better clip, start to reduce the losses there, and then I think you have a story where this stock is at new highs in not too distant future.
As Tim pointed out in that incredible power pitch.
Yeah.
All right.
No, wait, what? The setup for the stock,
for
the fast pitch, right? that one was really good as well.
That's good too, yeah.
The setup was really interesting. Off from that 147 high back in July, traded down to 125, basically a 50% retracement of a move we saw from the spring. So the setup in earnings was really nice, number one. Number two, don't discount this ESPN thing. And I remember sitting on this desk now, it seems like 2 years ago, when Disney was a $99 stock and floundering, and then it was reported during our show that all of a sudden gambling's being legalized. That was a lifeline that ESPN needed. That's why people are flocking back to ESPN, because I'll tell you, not that I gamble on sports, but you're far more inclined to watch if you have money on a game than if you don't. And that's, I think, why ESPN is doing as well as they're doing now. What does it mean? Well, 147 and change was a high back on July 29th or so. That's your line in the sand. We need a close above there over the next week or so. I don't know if it gets there tomorrow, but I think that's your bogey. 25 times next year's earnings. You can make an argument, I think, to Karen's point, in this environment, maybe it's not that crazy expensive.
With these earnings in the books, does that lessen the pressure on the launch next week of Disney Plus?
I think so. And because we don't know what those numbers are. Remember, they gave us numbers. I think they said 7 million subs and then 24 million subs by the end of 2024. We've all surmised here and tried to guess whether some of these distribution channels actually increase it and whether ESPN Plus is actually telling you you're going to be stronger. I think they're getting the benefit of the doubt. In fact, it's interesting. The irony is that as the competition heats up, it seems like everybody's getting a little bit, of a pass in the short run. In other words, look at Netflix. Despite the fact that it had a lot of pressure once these announcements were made, you've arguably seen Netflix rally as competition has gotten a little bit tighter in the last month or so. The thing about Disney that I just maybe I've already said this, but I want to say it again. There's 4 businesses here that are all kicking it. Studio is up 52%. Operating income is up 72%. Overall, and that's a business that's a $6.5 billion business. Parks and Resorts, $6.5 billion business. The media business, $6.5 million business. Studio is about 3.5, and then if you look at the DTC, another 3.5. You have 4 large businesses that are all doing very well separately, and that's why I just think that this isn't just a media company. This is kind of a must-own.
You made the point yesterday that we might not know really the fallout of this for at least 6 months, maybe
Right.
even longer, as people start really looking at what the content offerings are and deciding how much they're going to pay for what. So
Right.
at this point with Disney's run, I mean, that's a lot, given we're not really going to know the numbers for a very long
now
time.
that either it works to their benefit or not, right?
Yeah.
It depends on how the launch goes. I just think we don't have enough information to know. But to Tim's point, what we do know about the businesses that are not in as big flux, right? Everything's going really well, though, studios are very lumpy. They shouldn't get a huge multiple. To me, though, it all comes back to Netflix. How can Netflix be valued here when Disney's
valued
there?
over here.
Right? I just don't get it.
Well, here's one, though, that I go back to the parent of CNBC. Comcast is a cheap stock, trading 13 times next year's expected earnings growth of about 11%, 5% sales growth. I mean, to me, you think of a lot of the dynamics that Disney is kind of keying on right now. This is stuff that Comcast has had in the works for a long time. I mean, I think a lot of these stocks can work ex-Netflix. I think that we've seen North American subs decline, 2 quarters in a row now. They're at a price point. They just raised their prices earlier in this year. And Disney Plus, we know, is $6 or something like that. And they're taking off all their content, and they're going to make it right there. I just think that one of the things that Disney will start to trade off of when this service launches next week, they're going to introduce this Mandalorian. It's a Star Wars show. Jon Favreau's the director.
You cannot wait for the
I cannot
Mandalorian.
wait for it.
Every single day you're talking about it.
But think about it. This is a
Favreau.
$6 a month service. You get all your Marvel, you get all your Lucas, you get all your Pixar, you get all your Disney sort of stuff, and they're going to be branching out, doing a lot of the stuff that's just exclusive to their service.
So Comcast is interesting, the parent
Yeah.
company of this network, by the way, because they have theoretically the same pieces in place to create that same flywheel as Disney.
Sure.
Can it, though, create as strong and powerful a flywheel as Disney?
At half the valuation, though, I mean, is it worth making that bet? I mean, it's half the valuation of Disney,
Yeah.
effectively right here. Half the valuation of Comcast, by the way, is CBS, which has been floundering, recently bouncing off the bottom. So at a certain point, you play the valuation game. So I don't even know if in terms of Comcast, you need to know the answer. You just have to make the bet that listen, we can all agree that Disney deserves the multiple they get, but should Comcast trade at half that multiple? Shouldn't they get a little bump in this environment? And then shouldn't CBS? And I can't wait for this mandolin rain. It's going to be unbelievable when it comes out. I will
You
be.
and Dan can watch it together.
I can only hope. Can you,
Sharing
Dan,
the
will you do that?
popcorn.
Yeah, we'll do that.
That would be fun.